If you own a Canadian corporation, you have probably received contradictory advice about how to pay yourself. Your accountant said, pay yourself dividends, lower personal tax rate, less paperwork, no CPP contributions, keep more money in the company. Your financial planner said, pay yourself salary, generate RRSP room, build CPP entitlement, deduct the salary from corporate income, get access to group benefits. Both of them are right, in different contexts, for different reasons. And the fact that two qualified professionals gave you opposite advice on the same question is not because one of them is wrong. It is because the optimal answer genuinely depends on a set of personal variables that neither of them fully explored with you. This video covers the complete framework, what salary and dividends actually are, and how they flow through a Canadian corporation. The real tax numbers for 2026, not the theoretical integration principle, but the actual after-tax dollars. The non-tax factors that often dominate the decision, and the specific combination strategy that most Canadian incorporated owner-managers should be using. Because for most people, the answer is not salary or dividends. It is both, in the right proportions, for the right reasons. Before the tax numbers, the mechanics. Because understanding how money flows from your corporation to your personal account through each method is the foundation for every decision that follows. How salary works. When you pay yourself salary from your corporation, the salary is a deductible business expense. It reduces your corporation's taxable income dollar for dollar. The corporation remits payroll source deductions, income tax withheld, plus CPP contributions, both the employee portion at 5.95% and the employer portion at 5.95%, totaling 11.9% on earnings up to the YMPE of $73,200 in 2026. You receive the net amount in your personal bank account. At year-end, the corporation issues a T4 slip. You report the gross salary on your personal return. The salary generates RRSP contribution room, 18% of earned income from prior year, up to the annual limit of $32,490 in 2026. How dividends work. When you pay yourself dividends from your corporation, the corporation first pays corporate tax on the profit from which the dividend is paid. The corporation then declares a dividend from after-tax retained earnings. Dividends are not deductible to the corporation. You receive the dividend in your personal account. At year-end, the corporation issues a T5 slip. You report the dividend on your personal return with the applicable gross-up and dividend tax credit. The two types of Canadian dividends from a private corporation. Eligible dividends, paid from income that was taxed at the general corporate tax rate. 15% federal applies to income above the $500,000 SBD threshold. Eligible dividends receive the enhanced dividend tax credit, a larger credit that reduces personal tax more significantly. In Ontario, eligible dividends are taxed at approximately 39.3% at the top marginal rate. Non-eligible, ineligible dividends, paid from income that was taxed at the small business rate, 9% federal, applies to the first $500,000 of active income. Non-eligible dividends receive a smaller dividend tax credit. In Ontario, non-eligible dividends are taxed at approximately 47.7% at the top marginal rate, higher than eligible dividends, but still receive some credit. Why this distinction matters? Most small business owner-managers operating under the $500,000 SBD threshold are paying non-eligible dividends, which carry a higher personal tax rate than many people realize. The integration principle says Salary and dividends should produce similar total tax. In practice, the numbers differ by income level, province, and dividend type. Here is the specific comparison using Ontario rates in 2026, the most common province for incorporated Canadians, on $100,000 of corporate profit being extracted as personal income. Scenario: Ontario Corporation with $100,000 to pay out to the owner-manager. Option 1. Pay as salary. $100,000 gross salary. Corporation deducts $100,000. Saves corporate tax of approximately $12,200. Ontario SBD rate of 12.2%. Corporation pays employer CPP $3,867 on $73,200 YMPE. Salary above this has no CPP. Net cost to corporation: $103,867. Salary plus employer CPP. You receive $100,000 gross salary. Personal income tax on $100,000. Ontario, assuming this is your only income. Approximately $26,100. Employee CPP, $3,867. Net in your pocket, approximately $70,033. RRSP room generated, $18,000, 18% of $100,000. Total tax paid, approximately $33,967. Income tax plus CPP times 2. Option 2. Pay as non-eligible dividend from SBD income. Corporation pays SBD corporate tax, approximately $12,200, 12.2% Ontario combined rate. After-tax retained earnings available for dividend, $87,800. Declare $87,800 non-eligible dividend. Personal tax on $87,800 non-eligible dividend, Ontario. Approximately $23,000 after dividend tax credit gross-up mechanism. Net in your pocket, approximately $64,800. RRSP room generated $0. CPP contributions $0. Total tax paid, approximately $35,200. Corporate plus personal. Option 3. Pay as eligible dividend from general rate income requires Corp above SBD threshold. Corporation pays general corporate tax, approximately $26,500, 26.5% Ontario combined general rate. After-tax retained earnings, $73,500. Declare $73,500 eligible dividend. Personal tax on $73,500 eligible dividend, Ontario. Approximately $3,200 after enhanced dividend tax credit. Net in your pocket, approximately $70,300. RRSP room generated $0. Total tax paid, approximately $29,700. Corporate plus personal. The Honest Comparison Summary. Ontario, 2026, $100,000 corporate profit. Key observations. Non-eligible dividends, the most common type for small business owners, actually produce more total tax than salary, not less, at this income level in Ontario. This is the opposite of what many owner-managers believe. Eligible dividends win on total tax, but only if the corporation's income is already being taxed at the general rate, above the SBD threshold of $500,000. Salary produces the most RRSP room and the most CPP, both valuable for retirement. The numbers change significantly at different income levels and in different provinces. Alberta and BC have lower provincial rates that shift the comparison. Here is the vault, the one situation where salary is always the right answer, and the non-tax factors that often matter more than the tax comparison. Factor 1, RRSP room, the one where salary always wins. Salary generates RRSP room. Dividends do not. The RRSP contribution limit is 18% of prior year earned income, and earned income for RRSP purposes requires employment income or self-employment income. Dividends do not count. This is the specific situation where salary is always the right answer, regardless of tax numbers. If you have no other source of earned income and you want to make RRSP contributions, an owner-manager who pays themselves entirely in dividends generates zero RRSP room, meaning one of Canada's most powerful tax deferral tools is completely inaccessible. For a business owner who wants to use the RRSP as a retirement vehicle, which is an excellent strategy for drawing down RRSP funds at a lower tax rate in retirement, enough salary must be paid to generate the desired RRSP room. To generate the maximum RRSP room for 2026, $32,490, you need at least $180,500 in earned income in 2025. To generate the minimum meaningful RRSP contribution, you need at least some salary. Factor 2. CPP entitlement. Salary contributions build. CPP entitlement. Dividends do not. This matters for two groups of Canadians specifically. Business owners who expect to need CPP as a meaningful component of retirement income. Business owners who delay CPP to 70 for the plus 42% enhancement. The enhancement is on your actual earned CPP benefit, which is built only through employment contributions. An owner-manager who pays themselves entirely in dividends for 30 years will receive minimal CPP, potentially only the minimum flat-rate pension. The maximum CPP in 2026 is $1,507.65 per month. The difference between maximum CPP and minimum CPP is approximately $1,400 per month, a gap of approximately $16,800 per year in guaranteed indexed lifetime retirement income. Factor 3. Mortgage qualification. Banks qualify mortgage applications based on T4 income and net business income, not dividends from a private corporation. Many owner-managers who pay themselves entirely in dividends discover at mortgage application time that their qualifying income is significantly lower than their actual financial position suggests. Salary income is clean, documentable, and accepted by mortgage lenders without the additional scrutiny that comes with dividend income. Factor 4. Employee benefits. Health and dental benefits purchased through the corporation are deductible to the corporation when provided as employment benefits. They are a corporate expense that does not flow through as personal taxable income. A salaried owner-manager can access corporate-paid health and dental with favorable tax treatment. A dividend-only owner-manager loses this efficiency. Given everything covered in the previous segments, here is the specific hybrid strategy that most Canadian incorporated owner-managers in the $100,000 to $500,000 revenue range should be discussing with their accountant. The core hybrid. Step 1. Pay yourself enough salary to generate maximum RRSP room. To generate the 2026 RRSP maximum of $32,490, you need approximately $180,500 in 2025 earned income. For most business owners, a salary of $100,000 to $180,000 is the appropriate range, enough to generate meaningful RRSP room without pushing personal income into the highest marginal brackets unnecessarily. Step 2. Pay CPP on that salary, both employee and employer portions. Yes, CPP costs 11.9% total on the salary, up to the YMPE, $73,200 in 2026. Yes, that is approximately $7,734 in combined CPP contributions. This is the price of building a CPP entitlement that will pay you a guaranteed, inflation-indexed income for life from age 65 or 70 if you delay. For a business owner who may not have a pension, this is meaningful retirement income insurance. Step 3. Leave additional profit in the corporation. Any profit above what you need for personal living expenses stays in the corporation. It is taxed at the SBD rate, approximately 12.2% in Ontario, rather than the top personal rate, 53.53%. The after-tax retained earnings can be invested inside the corporation, in a corporate investment account holding bonds, ETFs, or other securities. You pay the low corporate rate now. You draw the funds as dividends when you retire, and your personal tax rate is lower. Step 4. Draw dividends strategically when personal income is lower. In years when your business income is lower, or in early retirement before CPP and OAS begin, the personal tax on dividends is reduced because your marginal rate is lower. Drawing corporate retained earnings as dividends when you are in a 30% bracket rather than a 43% bracket saves significant tax. Step 5. Use the TFSA regardless of income source. The TFSA's $7,000 annual contribution is not affected by income source. Whether you earn salary or dividends, the TFSA room is available. Max the TFSA every year. The tax-free compounding inside the TFSA does not care whether the money came from a T4 or a T5. The rule of thumb most tax professionals use: pay enough salary to generate RRSP room and cover personal living expenses. Leave the rest in the corporation. Draw dividends when you retire, and your tax rate is lower. Combine with TFSA maximization throughout. 5 questions. Answer them honestly. And the salary versus dividend balance for your specific situation becomes much clearer. Question 1. Do you need RRSP room? If yes, you need some salary. The amount of salary should be at least enough to generate your target RRSP contribution. If you have already maxed your RRSP or are approaching retirement and do not plan to use it, this constraint is reduced. Question 2. Do you want to build CPP entitlement? If yes, you need salary up to the YMPE, $73,200 in 2026. CPP is expensive to build, 11.9% total on the salary, but it pays a guaranteed, indexed lifetime benefit. For business owners without a pension and with significant longevity in their family, this is often the right trade-off. Question 3. Do you need the money now, or can you leave it in the corporation? If you can leave it, retain earnings in the corporation. Invest at the corporate rate. Draw later at a lower personal rate. If you need it now, the salary versus dividend comparison using your actual current marginal rates determines the efficient extraction method. Question 4. Are you planning to buy a home or need mortgage qualification soon? If yes, T4 salary income is the clean mortgage qualifying path. Ensure enough salary is on record before the mortgage application. Question 5. What is your provincial tax rate? The salary versus dividend comparison changes materially by province. Ontario's high provincial rates push non-eligible dividends above salary in total tax. Alberta and BC rates are lower and may make non-eligible dividends more competitive. Always run the comparison using your specific provincial rates. The answer for most Canadian owner-managers: a salary of $80,000 to $180,000, covering living expenses and generating RRSP room, CPP contributions on the salary portion up to the YMPE, remaining profits retained in the corporation at the SBD rate, TFSA, maximized every year, and dividend extraction planned for retirement years at lower marginal rates. This is not a single-size answer, but it is the framework that works for the majority of incorporated Canadian business owners earning $100,000 to $500,000 in business revenue. Work with your accountant annually. Tax rates change. Business income changes. Personal circumstances change. The salary versus dividend analysis is not a set-and-forget decision. It should be reviewed every year with a qualified accountant who knows your specific numbers. Let's come back to where we started. Your accountant said dividends. Your financial planner said salary. Both were right, for different reasons, in different contexts. The complete answer for most Canadian incorporated owner-managers earning $100,000 to $500,000 in business revenue is a combination. Enough salary to generate RRSP room, build CPP entitlement, and qualify for a mortgage if needed, with remaining corporate profit retained and invested at the low SBD rate, drawn as dividends strategically in retirement when the personal marginal rate is lower. Non-eligible dividends are not the automatic tax winner many people assume. In Ontario, they actually produce more total tax than salary at many income levels. Eligible dividends do win on total tax, but are only accessible when corporate income exceeds the $500,000 SBD threshold. The TFSA is the equalizer that works regardless of income source. The salary versus dividends question is genuinely complex. It depends on your province, your income level, your RRSP goals, your CPP intentions, your mortgage plans, and your retirement timeline. The framework in this video gives you the foundation. The annual conversation with your accountant gives you the specific numbers. The only clearly wrong answer: making this decision based on a general rule without running the numbers for your specific situation.